I've been in the ESG space for around 10 years, which makes me pretty long tenured for most people in the ESG market, given it has really been growing in its strides over the last decade or so that I've been involved in it, and increasing in importance to both firms but also to our clients and to end investors. Maple-Brown Abbott is an Australian-based global equity manager. We've got strategies across Asia, emerging markets, Australia, listed equities, listed infrastructure rather, and we take a deeply integrated approach to ESG across all of our strategies, but we apply that in strategy relevant ways. So my role is really responsible for, I guess, the central coordination of each strategy's approach to ESG, but then also bringing out the supposed material risks and material opportunities and taking the best practice thinking and bringing it in-house to make sure that we are staying very much ahead of market. So ESG has always been about risk mitigation, and if you think of where it came from, it was designed as a way to add additional information into investments. So there's probably three key levers that we think of when we talk about ESG, the risk mitigation. First is that deep traditional ESG integration. So we will pull that into our company valuations, into our portfolio construction, and very much looking at how much a company or an investment, a bond, might be impacted by the ESG or the non-financial factors, as some people call them, and how they might influence that investment. The second is what we call stewardship. So we manage risk through stewardship by engaging with the assets that we invest in to make sure that they are, managing their risks well, and certainly we'll use those opportunities to engage to press for outcomes where we think we can best influence, and also using our proxy voting rights. And then thirdly, capital allocation. So I guess we have a really important role where we can, as investors, direct where our investors' money goes, and we will use our knowledge of companies and of their management of ESG risk to direct that capital towards the companies that we think are best managing their risk to further, influence and further bolster the market in the sense of ESG. So Australia has got a pretty small ESG bonds market at the moment, but it's got some pretty ambitious goals around net zero, for example. So Australia has committed to become net zero greenhouse gas emissions by 2050, and that's going to require quite a lot of investment in terms of funds and flows to support sustainable finance. And in recent times, we've seen the Australian government make some commitments around a sustainable finance framework, of which green bonds are going to be a really key part. Some of the other things that they're looking at around taxonomies or around mandatory climate disclosures. But back to the green bonds. So it's a pretty small market, as I said, although it has grown a lot in the last 10 years since it's really come into existence. And one of the really exciting things is the Australian government has recently committed to its first sovereign green bond issuance, which we're going to see sometime mid-2024, we expect. And I think that will really bolster global investor confidence in Australia. And some investors that might have been sitting on the edge and worrying a little bit about Australia's green credentials, we think will start to pay more attention to Australia, and particularly around green bonds. Climate-aligned indices in Australia face two key headwinds. The first is that the Australian market is largely concentrated in very carbon-intensive resource stocks. So that makes it quite challenging. When you compare our index to others across the world, already if we do nothing, the sum total of the climate commitments in Australia at the moment will not get us anywhere close to net zero. So already we're coming from quite a behind point. We've got a lot of running to do to get to a climate-aligned index as a market. The other key issue that is really stopping allocators going down a climate-aligned indice is the role of superannuation in Australia. And under the current Australian regulatory framework, there's legislation called Your Future, Your Super, which means that super funds, which currently manage about 3.5 trillion Aussie dollars on behalf of its beneficiaries, really need to be aligned to one of a number of specified benchmarks. And at the moment, none of those benchmarks are aligned to a Paris-aligned outcome, which makes investing for super funds, who control a lot of asset allocation in Australia, very challenging. And some research has shown that if we were to manage to a climate-aligned index through exclusionary practices, you'd have a tracking error of around 5.1%, which is untenable for a super fund in Australia, which means that there's not that kind of impetus to go into climate-aligned indices right now. So those two things have made it a little bit challenging. There is a lot of work and a lot of response from investors across the market, working with the government, working with sustainable finance strategy to hopefully drive some change there, because we see it as a really important way to mobilise capital towards a climate-aligned future. There are a number of climate-aligned indices that just really haven't got a lot of traction in Australia. So the methodologies, I guess, that you would use would be either through, again, kind of three levers that you'd pull would be just straight exclusion practice, which is a pretty blunt tool, and it also means that you're not having the opportunity to engage with companies that really do need to transform, so those really carbon-intensive resource companies that I spoke about before. So exclusionary practices are probably not the preferred option, certainly for us, although a lot of investors do see some credibility in those. The second one is, I guess, tilting a portfolio to allocate more capital to those companies that we see are transitioning towards a lower, carbon future, so that are more, I guess, net zero aligned. And that's certainly something that I think has got a lot of traction, and I'm going to see more and more focus around climate-aligned companies, and rather than just a straight, hard, Paris-aligned trajectory, very much around companies that we might have credible net zero targets and allocating more capital to those, for example. So that's the portfolio tilt. And then the third part is ongoing stewardship, so working with those companies in the portfolio and being very clear around the outcomes that we'd expect a company or an issuer to commit to in order to get to a net zero future. Emerging markets, as we know, surprise for anyone, is an incredibly broad market. The countries that make up the EM index vary widely in their climate commitments to date. And there are obvious challenges in some of those countries around whether it be a lack of viable investment or viable technology pathways to get to net zero, or certainly trade-offs that might have to be made around other commitments or other sustainable development goals. So that said, though, there is an awful lot of opportunity, and we are seeing a lot of EM markets taking a really fast transition, and we know that when capital is mobilised in the right way, the speed of the transition is often a lot faster than what we may have expected beforehand. So there is a lot of opportunity, and I think what is really key when we're assessing EM markets for climate opportunity is to be very clear that there is no one-size-fits-all. So we cannot hold all jurisdictions and all companies to the same bar. And by that, I think a good example might be in India, where the company has made, not quite a commitment, but an indication that they might be targeting net zero in India for 2070. So you would expect that a company in India to have its processes, its capital allocation frameworks, its commitments aligned to 2070, as opposed to a company here in Singapore that's got a much more ambitious net zero 2050 target. So I think that cultural relativity piece, as well as the specific policies, regulatory frameworks, cultural expectations, consumer norms of the countries that a company is operating in, is incredibly important. And from an ESG perspective, that's exactly what we're trying to do. We're trying to assess a company for its exposure to opportunities and to its risks, and not taking a very blunt, one-size-fits-all approach. So obviously the opportunity to learn from best practice thinkers across the market, it's just invaluable. The sessions give a really great opportunity to get insight and to continue to learn and grow, which is what these conferences are so good for. But in particular, one thing that I would say about this conference is, I suppose, not just learning from, but also being challenged. So already some of the thoughts that I've had coming into the conference, I've had alternate views put to me, and it's been really great to be challenged on my own views and to really test the robustness of some of the thinking in that space. And the second part of that is, quite obvious, the networking opportunities. So it's so great to be able to come together with my peers across, all of the different countries that are represented here and all the different parts of the market to continue to grow and learn from each other in a more informal way, as well as in the formal sessions.